Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and you're tuning in for our 88th VideoCast and 78th podcast for the week ending June 25th, 2021. We have a lot of great stuff to cover this week, and we're coming to you live from Tampa. The girls have another swim meet down here, so we're excited for that. And want to, first off, we'll start with our media spots, go through some of the key important information in those, and then we'll get right down to the meat and potatoes. So first, I'd like to thank Ellie Terrett and Liz Clayman for having me on the Clayman Countdown on Tuesday. And the subject was the Chair Powell's testimony to Congress. And basically, it came down to a couple of key things. Despite Bullard's hawkishness on Friday that threw the markets into a tailspin, Powell reiterated that he believes inflation is transitory due to base effects and short-term supply bottlenecks, as well as a point he made was that the downturn disproportionately hurt low-wage workers. And that specifically means out of the dual-pronged mandate of stable prices and full employment, he's choosing full employment. He wants anyone who wants a job to get a job across demographics, and he'll run the economy hot until that happens. He has perfect cover to do that. Unemployment was 3.5% last February. In 2020, before the pandemic, it's 5.8% now with 9.3 million unemployed. And Powell's driving the bus, so it's pedal to the metal. And he said explicitly last week, take the dot plot with a huge grain of salt, meaning his colleagues who are saying 2022 rate rises are premature in their viewpoints. And which means effectively no taper until 2022, no rate rise until 2023. And the yield-sensitive groups that we've been speaking about, namely whatever got hit earlier in the year when the 10-year went from 100 basis points to 175 basis points in 6 weeks, namely tech, utilities, staple, and pharma, specific pockets in those groups, could now start to see some strength over the summer. We've already seen it in a material way in the last 3 weeks since we've been pounding the table for tech, specific pockets of tech, and we'll talk more about that on this call. And this is a period of seasonal strength. If you look past the last 20 years, these groups tend to do well when the rest of the market tends to go sideways, which is from May through October. And then finally, of course, for the market to push higher, big tech would have to participate because they're still well over 20% of the weight of the S&P 500, and we've been seeing that in recent days and weeks. So Splunk, we emphasize because we've been pounding the table on that for the last 3 or 4 weeks, and Splunk is now up since we suggested it on Liz's show. It's now up about 30%, and that was catalyzed. It was down at a 111. It's now, it got up to 143. It closed the week around 141, so about 30 points. That's good to see. Silver Lake put $1 billion investment, put someone on the board. It's a convertible debt instrument that converts at $160 per share. So basically that will be the short-term ceiling, except for the fact that Splunk authorized a $1 billion buyback to offset that $1 billion of what could be potential dilution at $160. So it's a net, and they've got Silver Lake behind them, and they see what we see, which is that this is no different than Microsoft's transition from licensing and software, Adobe's transition from licensing to, and software to cloud and subscription model. And they're just crushing it. So that's exciting to see, and we think that's just beginning. Obviously, after a huge move in the last week or so, 30 points, expect some consolidation. It doesn't, it doesn't go straight up, but it's on its way, it's finally out of the doghouse, which is really, really exciting. And for those of you who have been with us, if you recall, after they did earnings about 3 weeks ago, the stock collapsed from 120. It started going up into earnings. We were, optimistic about it. After earnings, it collapsed to 111, and we were buying, and we said that on this podcast. And now it's off to the races again. So that's good to see. The other stocks that we've covered in recent weeks on the Clayman Countdown are Netflix, Amazon, and Baba. They're all getting bid. We're going to spend a lot of time on those. And then we also said that while we like these type of names over the summer and some defensives, we do believe that the reopening trade will, while it may take a breather over the summer, will come back in earnest at the end of the year as we get closer to tapering in 2022. And certainly some of this infrastructure spending and reconciliation package that has been talked about this week will start to come to pass, and the market will come to grips with the amount of spending. Rates will go up, and the reopening trade will benefit. Value will benefit in a rising rate environment. Tech tends to do better in a stable or falling rate environment. So we like that over the summer, and we'll adjust in the fall and probably be taking profits on some of these things that we've been emphasizing for the last 3 weeks as we get closer to the fall. So that was the Clayman Countdown. So thanks again to Ellie Terrett. Moving right along, we had a great Bloomberg radio interview on Wednesday with Brian Curtis and Paul Allen on Bloomberg Daybreak Asia. It aired if you were in your car at 7:08 p.m. in New York City. It was the whole half hour through 7:30 with all the commercials and all the announcements. Now, the original recording I put out on the site was the full, whatever it was, 23 or 25 minutes. Bloomberg has put it up directly on their website without any of the commercials, without any of the interruptions, and it's only about 7.5 or 8 minutes. You can click on this link here at hedgefundtips.com and play it. I think this is really a worthwhile listen because it goes into a tremendous amount of detail on Alibaba. It covers obviously the Fed things that we've talked about, inflation, etc. But it goes into the 3 reasons that Chinese stocks were down, the Archegos blow up, the Chinese crackdowns, and the inflation fears earlier in the year. And then it goes into the 6 reasons why we like Baba. It's trading at a 33% discount to its historic PE multiple. It has traded at 28 times since going public. It's trading at 18 times next year's earnings right now, so you're getting it at a huge discount. You can buy it at June 2018 prices, despite its doubled cash flow per share, doubled revenue per share, doubled earnings per share, so double the business for the same price. The Ant Financial IPO, we're going to talk about that one today. There's been some new developments that we've been anticipating, but they're starting to show up. We now think that IPO will probably happen, which was not a real possibility a month ago, and we've been kind of leaning in that direction on these recent podcasts. Obviously, the growth of Ali Cloud relative to AWS, it could catch AWS in a handful of years. The fact that the government and Chinese government needs Alibaba due to their dual circulation plan. They have to keep internal consumption growing as a hedge to a more difficult export environment. They're having difficulties with Australia. The U.S. is trying to get Europe to join them to put a little pressure. Probably won't do much there because Europe needs China much more than the United States does. But they do want to keep the internal consumption, and to do that, you obviously want to have the biggest platform in the country, which is Alibaba. And they need the Ant Financial platform to roll out the digital yuan. And now they're doing a joint venture with the government. Jack Ma controls Ant Financial, and they've agreed to give the government their data to do a nationwide credit scoring service, kind of like Equifax and that type of thing in the TransUnion in the United States. Which shows that they're cooperating, and because the government tried to do it on their own and they failed, surprise, surprise. So now they need Ant Financial to do it, and it will be in their interest now to see Ant Financial succeed and to see BABA succeed, and that's why I think the IPO will go forward. That's why I think the $2.8 billion anti-monopoly fine is in the rear view mirror. There will be guide rails, but the more regulation there is, the more Alibaba gets bigger and small players can't enter in the space. And then the final reason was Charlie Munger bought it in Q1 for Daily Journal, which is his public investment vehicle, and he made it 20% of the portfolio. It's his second or third largest position behind the banks. And so you can buy Alibaba today, not only at a discount relative to 3 years ago, so you get double the business for the same price, but you can also buy at a discount to Charlie Munger's new position in Q1. And to me, that always makes sense. Particularly if you had bought BYD, the battery maker, the Chinese battery maker, when Charlie was doing it for Berkshire, you would have made a tremendous amount of money. He's close friends with Lilu, who is the best hedge fund manager in China, and a huge proponent of Alibaba, and knows the inside track of everything that's going on. So I can't have that kind of perfect information, but they can, and it makes sense from this standpoint. So I want to thank Yang, the producer. Jung Soo Maing, the TV producer, will be on Bloomberg TV July 20th. And then also Venus Fang and Abhishek Vishnoi, because I believe they had me in their article, their Bloomberg article that led to the radio and the TV appearance. So the radio and future TV appearance. So thanks to them. Also want to thank Lydia Moynihan, who moved over to the New York Post from Fox Business, and she is just crushing it with all of her articles, and she asked me to be in one of them. This was related to the business travel. There was a survey out that business travel is down, and everyone is pessimistic on business travel. And when you look at the TSA numbers, I think when she called me, it was like 4 or 5 days ago. Yeah, it was Monday, and the business travel was 2.1 million TSA pass-throughs versus 2.7 for the same day pre-pandemic in 2019. We've hovered above 2 million, so we're starting to close in. But the survey that she was quoting was saying that, will companies go back? They're saving so much money not traveling. And I think the other gentlemen who were quoted were kind of like, yeah, the world's changed forever, etc. But I think that sounds more like people felt after 9/11. And sure enough, it comes back sooner or later. I think in this case, it's going to come back much sooner. And the reason is, while everyone says I want to spend 24 hours a day with my family every day, after a year of doing so, many people just wouldn't mind doing a 2-day road trip to go get some business. And what I said is, sure, these companies will save money on travel until they start losing business. Tom Hayes, founder and managing member of Great Hill Capital, tells the Post, no one in their right mind wants to get on a Zoom call anymore. They want to get a steak dinner. So that was my quote. Thanks to Lydia for having me on. Quoting me in her article. And then this is the Bloomberg article that led to the radio and the TV. I was talking about Chinese stocks, and this article was by Ishika Mukherjee and Moxie Ying. Thanks to Ishika and Moxie for having me in the article. And I said yield-sensitive groups which fell on inflation and tightening fears earlier this year, tech, utility, staples, healthcare, could begin to outperform the groups that led in the beginning, i.e. banks and energy, and raised their allocation to Chinese tech stocks after the Fed's move, particularly Alibaba Group, he said, citing cheaper prices after the recent sell-off. No question, Alibaba's our number one position, so yeah, that's a good thing. All right, and then finally, I want to thank Devik Jain and Meta Singh for quoting me today in Reuters. We were quoting some of the inflation data earlier. I said the data is giving people a breath of fresh air and that the inflation fears may be a little overblown, says Thomas Hayes. You had this divergence of opinion among Fed members, and what everyone seems to forget is that Chairman Powell is driving the bus and he has the pedal to the metal. So we've covered that. Here's the Splunk move from 110 to 140, so that's moving in the right direction. And now we're going to get to the Ask Me Anything part of our podcast VideoCast. The questions have been phenomenal. This week, we're going to take all of them. We had quite a few, 1, 2, 3, 4, 5. First one, hi, Mr. Hayes. My name is Murat Asatrian. So thanks, Murat. Just want to say that I wait for your podcast at the end of the week, every week, in order to get my head straight with what is happening in the markets. Thank you so much. I have 2 questions. Oh, so 6 questions then. One is that with the possibility of the Fed lowering the bond purchases, that's tapering, reducing their bond purchases from $120 billion a month to less, would it be all right to buy companies such as BXMT, which is the BlackRock Mortgage Trust, which hold large mortgage portfolios, as the spread would most probably get larger, and so they would be able to make more money? And also, where can a future hedge fund manager be able to find investors other than friends or family? Okay, so 2 questions, good questions. BXMT. Okay, so this has had a huge run. Pre-pandemic highs was 35. It's back up there. These, ironically, I understand your point about the spread. These will largely trade on the basis of their yield. So let me just take a look at what the yield is here. So as rates go up, which is your point, is that rates will go up sooner or later, even in the short term if they go in the opposite direction. The trend is probably up. So, okay, so this instrument yields 7.51%. Right now, that's extremely valuable with a 10-year yield around 153 or 154 basis points. I don't know where we closed today, so somewhere in there. As tapering happens and the long end blows out a little bit further, the value of that 7.5% yield is going to go down, irrespective of the internal spread that he's referencing between what they pay for capital and what they get from their investments in mortgage bonds. So yes, could this push a little higher? You bet. Could it persist higher? Yes. Is this something that I'd really want to get a lot of exposure to here? Probably not. There are better things that are just getting started that we've been emphasizing that I'd be more focused on at this stage. Will it work? I mean, could it push to 36 or 38 over the next 5 or 6 months? Perhaps, but I don't think it's the best use of capital. And where can a future hedge fund manager be able to find investors other than friends or family? Well, a lot of us start with friends or family. I started with my own capital. So what I've found, well, this is going to be funny. One of my favorite movies when I was growing up was a movie called Swingers with, it's the clean version, with Vince Vaughn and Jon Favreau, and they're best buddies, and they're going through dating ups and downs and making their way. They move out from New York to California to become actors, and you go through the whole scene of an up-and-coming actor. Long and the short of it is, Mikey is the name of Jon Favreau, Trent is Vince Vaughn. They get in Vince Vaughn's convertible Fairlane to go from California to Vegas overnight, as so many young Californians do. They make the trek. And as they're getting close, and you can see the lights of the strip come up, and they're in their beautiful convertible. They've just driven for, they start the journey. They're so excited. By the end of, as they're getting close, they're like falling asleep. It's probably 2 a.m. And Mikey starts to see, Trent's driving. Mikey starts to see the lights, and Mikey's like, Trent, pull over. You got to put your suit on. And Vince Vaughn is like, what do you mean? Why do I need a suit? This. And sure enough, he goes, listen, Trent, the reason you have to wear a suit is you got to walk in there like you own the place, because the way it works is when you don't need the SHIT, they give you the SHIT, i.e. the comps. And it sounds like such a simple line, but it is the most profound metaphor for life. when you don't need the capital and when you don't need the additional clients, that's when it just starts to flow in from left and right. So, and why wouldn't you need the clients? Because you're so good at what you do that you don't need outside capital. And that's far more important than where do you go to network or where do you show your little pitch book or whatever. That none of that stuff is really valuable. I mean, can you go do a sales process and all that stuff? Yeah, some people do that, and many people probably do that better than I do. I've never been about that. I just do what I do, and it spreads by word of mouth. That's the most important thing. So the number one advice I'd give to you, Murat, is make sure your performance is stellar. Make sure your process is proven and rock solid, and that you have all the confidence in the world to start with your friends and family if you don't have a tremendous amount of capital on your own, but you better have a track record on your own, or it's too early to start your own shop. Go work somewhere else, go learn your process, go study and experience more. If you do have a track record, then just keep growing your own capital. Grow the few people who have started with you if they're friends and family. And if you do a good job for people, they will recommend you. It's just inevitable. It's the law of reciprocation. If you do a great job and add more value than they could ever imagine, then they will not only add capital to you, they will suggest you to your friends, and it will grow by word of mouth. So, and this is also in line with a mentor I had in my early 20s, a guy named Jim Rohn, who was also a mentor to Tony Robbins, and he has a famous quote. He said, "Success is not to be pursued; it's to be attracted by the person you become." And I think in the context of growing a hedge fund business, you can go out and pursue clients and try to join all the right clubs and network and yada yada yada. But by and large, if your process is right, if you love what you do, if you do it 24 hours a day, if you have the performance, you'll be your own best client and you won't need outside money. And the minute that happens, like Mikey said to Trent, when you don't need the S, they give you the S. And we're not talking about some free chicken dinners in Las Vegas. We're talking about assets. That's when it just starts to flow. And that's just a function of how well have you developed your process? How well have you developed your skills? How is your performance? And if you have the performance, you'll never have to worry about capital. It will come by word of mouth over and over. And if you want to, do a whole sales process and pursue people, you can do that too. But it's really not needed if the product's good. Basically, you want to get so good in your abilities over time that it would cost someone too much money not to put money with you. Even if they hated you, they would have to put money with you because it would be far too costly to consider the other alternatives. And then that question won't become a factor moving forward. So if you're there in your process, then you won't have any problems. If you're not there, then you just need to keep learning, developing, experiencing, and growing. And that's time. Don't be in a rush. There's plenty of time, and keep getting better, and you'll get exactly where you want to go. So great question from Murat. Now we're going to move to question number 2, or questioner number 2. Ben, first name only, please. Hey, Tom, podcast question, please. What's your latest thoughts on when an agreement with Iran will be reached, causing oil to drop, and what's your best guess on the range of the oil drop? Thank you, Ben. Well, it's funny you bring that up because in that Bloomberg radio interview, I actually covered the black swan because they were all excited on energy. And I said, basically, with everyone excited at 73, no one wanted it at 30 and 20 and 10. When we were talking about Exxon, everyone wants it at 60, 70, and 80. And with 73, there's all the articles coming out, oil going to 100. And usually when you have that much late money reluctantly forced into a group that they didn't want to be in, they get shaken out. And I think what no one's paying much attention to is the fact that this new administration is Iran friendly. They're going to wind up doing a deal. And when they do, in the short term, the 3 to 5 year trend is up. There's no questions, supply-demand dynamics, restrictions on drilling, etc. But in the short term, I think they're going to take the stuffing out of all this late money that's come in the last 4 to 6 weeks after many of these names are up 75, 100, 150, in some cases 200% off of the pre-election lows when we were talking energy and oil like crazy, and everyone was saying that it's all over, just like they were saying about banks. So I would strongly urge you to listen to this, the 7-minute version. Don't listen to the commercial version; it'll drive you crazy. I can't even listen to that. But the 7-minute version for sure. Now, the Iran deal. There was a note out today on Bloomberg. Iran misses deadline to renew nuclear monitoring pact. So there's been some back and forth about this. It's been delayed. And they're saying, well, you can inspect certain things. And this is just a posturing that they did before the pre-Trump administration dumped a bunch of platforms of what do they call those, pallets of cash they dumped out of the back of an airplane on a tarmac to basically pay them off to allow access and do that deal. I think it was 180 billion. I could be wrong on that, but it's 5-6 years ago. So expect something along those veins, and this is how they posture. And this particular administration is going to be amenable to that. They've wanted to do a deal. So Iran will just say, I'm closing you out until you give me money and you release the sanctions. The minute they remove the sanctions, Iran's going to dump a ton of oil on the market. What do I think it does to the price of oil? I think I said at the Bloomberg interview, it could be $5 to $10 a barrel, but to individual energy stocks that, you're probably looking at a, 5 to 10 to 20% correction. So like I've been emphasizing, we think that the cyclicals will take a breather. That could mean sideways. It could be down over the summer. We think some of these yield-sensitive groups will do better. I also wanted to just show you one of the things we look at when it comes to commodities, certain commodities, is what are the commercial hedgers doing? And they're selling, and they tend to sell ahead of, short-term tops. When you get a weakness, again, see here, they're selling ahead and then it rolls over, selling ahead and it rolls over. And they're kind of doing that here, selling ahead and rolls over. I think that's inevitable, and I think the Iran deal is going to be the catalyst. Now, do I see $80 to $100 plus 3 to 5 years out, and some of these oil stocks up another 50 or 100%? You bet. And we'll probably use the shakeout to add back a lot of these. We've trimmed a number of cyclicals, not meaningfully, but modestly over the last month or so in anticipation, since we've been talking on this podcast, VideoCast, and we look to add back because we like them long term. Moving on to the next question. Macau, let's see. He didn't specify if he wants his full name said, so I'm going to just say Macau. Hi, Tom. I'm a big fan of your podcast. I'm very grateful for all it's taught me. I was wondering, how do you go about identifying opportunities for investing? I understand your thesis for investment in particular stocks such as Splunk, Alibaba, or Novartis, but what brings your attention to them and at the right time? Do you have a screener of, say, X amount of stocks that you know well and look at weekly? Thanks for sharing your wisdom. Yeah, I have this very, very fancy screener. Here it is. You go to finviz.com, and I just sort by large cap, and I sort with stocks over $2. Why do I do large cap, and why do I do over $2? 2 reasons. Number one, liquidity, so I can put on size. Number two, if I want to express the position through options, there will be a deeper market and better pricing for the options. So I can do that better through large cap. Number 3, better information is available to me. It's more efficient. And so that's how I do it. Now, what do I look at on a weekly basis? Nothing. What do I look at on a daily basis? 1,000 stocks every single day. So when you pull up large cap, you'll see 39 pages of 25 stocks. And I just go through them, and I do it in ascending. I think it's ascending. I don't know what it is. The ones that have gone up the most for the day are on the first page, whatever they call that. Descending, doesn't matter. But I like to start at the back. I like to look at everything that's gotten beaten up. And then, I'll look at it. This is a daily. You can also switch to weekly. And I just look at what's down, and it doesn't matter. I don't buy something because it's down. That's where I start the process. Why is it on sale? Does it deserve to be on sale? Is it persistent? And, you know, I'll just write down whatever, 20 or 30 tickers out of, you know, 1,000. And then I start to, that's when the research starts. There's no, you know, magic oscillator or anything like that. I do have a good feel for sector rotation. That's my knitting. I think I do that as well as anyone in the business, and very well. It's just a kind of just developed over the years, and I know that that's my huge competitive advantage. But you know, I basically am a top-down, bottoms-up. And then I'll just start my research process on, you know, 10 stocks. And, you know, it's like Buffett. He did a $5 billion deal during the great financial crisis while he was in his bathtub over the phone without looking at any financials, without doing this. And they're like, well, how could you put $5 billion to work in 5 minutes? He goes, because I've been following the same companies for 40 years. I know them like the back of my hand. And it's the same thing. You've seen enough cycles. You obviously you confirm it with research and you do the background, but you just need to observe. You know, observation is the absolute critical key to mastery over time. You just observe cycles, what works, when, and then you drill down and you start your basic fundamental research. Read the annual report. Start to read all of the earnings call transcripts. Start to look at the earnings and cash flow per share over the last 10 years. Look at the range of multiples it's traded in on average over the last 10 or 20 years. Is it towards the top end or the bottom end? Why is that? What is the discount rate? How's the sector doing? Is it cheap for a reason? Is it going to stay cheap? Is it going out of business? Is it a sector that's done for good? So you have to go through all of these things, and it just takes time and experience, and you have to douse yourself in like you are by listening to this. So you'll learn a lot doing this. But I go through these 1,000 stocks every single trading day. So, and I just see these, and I've been doing it for years and years and years. So I just see things that happen over and over. You know, history doesn't repeat, but it definitely rhymes. And another thing you can do, you know, I tell every new person, you know, read The Institutional Investor by Benjamin Graham. Securities analysis, if you want to, on top of that, that'll give you a deeper understanding. Read every annual report, every annual letter that Warren Buffett's ever written. You can find them at berkshirehathaway.com. And then if you're still serious, start to read the CFA books. And you do those 4 things, that's the basis. You know, 99% of the people I tell that to won't do it because, you know, it's just, they think it's their passion because you can make a lot of money. But when it comes down to doing the work, they realize they're not really passionate about it. And maybe they go start a tech startup that does gene editing, and they make, you know, they become the next Elon Musk. And, you know, the other thing that's very interesting, there was an article this week in the New York Post that said, Warren Buffett's given away half of his shares, and it listed and he's worth $100 billion. So, you know, a lot of people are so excited about Jeff Bezos and so excited about Elon Musk, and I'm a huge Elon Musk fan and the whole thing. But after reading his book, I was like mixed bag beforehand, like not mixed bag, agnostic, like didn't love him, didn't not love him. But after reading the book, I really have a tremendous amount of respect for him. I totally recommend that book to everyone. I think it was written 3 years ago. It's the only one about him. And it covers a lot on SpaceX. But what people realize, and people give Buffett a lot of slack, like, well, he's underperformed the S&P for the last 20 years. Well, it's the law of large numbers. You know, it's easier to outperform when you're managing $100 million than it is when you're managing $10 billion. And it's much harder to outperform when you got, a $250 billion or a $500 billion company and all those assets to put to work. However, if you add back the stock that he's given away, he's still the richest man in the world. He gave away half of his shares over the last 15 years. Otherwise, he'd be worth over $200 billion, and he'd probably be number 1 on the Forbes 400 because neither Musk nor Bezos has given a material amount of their wealth to charity, although Bezos had to give a decent chunk to divorce, which is winding up going to charity. So I think for my money, in terms of business and understanding business, you're not going to get a more valuable lesson than reading Buffett's annual letters. And he's still, in my book, the richest man in the world. So I would think about it that way. But you have to go through the process. You have to do the fundamental analysis. You have to listen to the conference calls. And yeah, do I look for things that are cheap? You bet. So here's one, RLX, and I like Chinese stocks, but I look at this, it's trading at 5 times sales. It's a vaporless thing. So I take a pass. I take a pass on a bunch of these. Some of these education stocks are getting kind of interesting because I think they're pricing in worse than the worst case scenario, which likely won't come to pass in terms of Chinese regulation. But that's a whole nother hour call, which we're not going to do right now. But I think that's a great question, and I appreciate you asking. I wish I could give you a quick, easy answer, but it's not the way it works. Otherwise, everyone would be having the same level of success. Okay, Shannon. Let's see. He didn't specify first or last name, so Shannon, Tom, understanding we think the Fed does not make any moves until early next year. Curious your thoughts on positioning for higher rates versus a steeper yield curve. Okay, this is a good question. Number one, would have thought the Fed announcement last week would have at least kept rates flat. And yes, we have made back much of Friday's drop. So do we think the big drop at the end of last week was merely the poison apple delivered by the 3 wicked witches? I guess he's referring to Bullard and a couple of the Rosengren and a couple of the other hawks. And two, as we look out towards next year when the Fed does begin tapering, how are you thinking about positioning for higher rates versus a steeper yield curve? As a simple example, and of course, there are so many more variables and differences in potential returns, but keeping all else equal, we can sell bonds regardless of duration, and if rates go up, we win. Or we can buy banks, rates go up, but curve flattens and we lose. Curious how you're thinking about positioning for this dynamic. Okay, so I'll give you the simple answer, Shannon. I think short-term rates are going to be stable in the summer, if not go potentially lower in the short term. So I think you could see as low as 135 bips on the 10-year, and that's why I like these. Tech, which has now moved up a bit in the last few weeks. We've been talking about for the last few weeks. I also think we're going to get a secondary. Remember, we got the big move off the lows in late February for like 6-8 weeks, and they've been consolidating sideways and been soft the last few weeks. Utilities, some staples, and some big pharma. I think they're all going to take another leg higher between now and the fall. And an environment that would prompt that would be this kind of 130 to 150 or 160 range, but not much higher. I think as we move to the end of the year, as tapering becomes more imminent, and by the way, I don't think we get a real tapering plan in Jackson Hole at the end of August, which most people are looking for. I think that's pushed a little further out, which would create the environment for what I'm talking about. And towards the end of the year, as we get closer to reconciliation and the Republicans realize they just got fleeced and they're, $4 trillion of spending is coming with or without them, then the market's going to come to terms with the amount of spending, number one, and the potentiality of tapering in Q1 of 2022. And that's when the rates are going up, and that's when the cyclical reopening trade is going to go from rest mode over the summer, if not, slight weakness mode over the summer, to roaring back strength, which I think persists for another few years, as we're still only a year into the business cycle. So that's how I'm thinking about it. As far as bonds go, I think, this short, we have this short-term strength here. I wouldn't be buying a ton of bonds really at all anyway. And I think that any nice weakness in banks is to be bought. Now, that said, we've been looking for this correction in banks. Let's see. Let me pull this up. And we may, it's unclear whether we may have gotten it all in a few days, because the whole group corrected. Let me just pull this up. So this is the XLF. This whole group corrected like 10% in the month of June, from in 3 weeks. So we did get that pullback. Obviously the stress test results were positive. They all passed with flying colors, so they're going to be able to buy back stock and issue dividends. That was kind of known. So it was, more or less, they were up 1% or something after hours, but it was kind of buy the rumor, sell the news. Now, in the case of Wells Fargo, they still have that asset cap removal catalyst. So, if you get any real weakness in Wells Fargo, low 40s, high 30s over the next few months, I don't know if you will or you won't, which is why we only trimmed modestly. And you already got this 15, 20% move, which is already retraced. So we may have got exactly what I was looking for. I don't think you're going to shoot up to the moon here. I think even if it's an uptrend here, it's going to consolidate sideways. I think there are other things that will perform better in the next few months than banks and the cyclical trade. So we may have gotten 100% of what we were looking for, but I just think there's a period of resting and regrouping and consolidation before we get rates going up again in the back half of the year and the reopening trade picking back up for another couple of years. So it's just better uses of capital for some of it and other areas to take advantage of. Okay, so here's a note about, let's see. So that answers Shannon's question. And then finally, Ben had a second question. What do you see for XLF financials in the coming days, weeks, or over the summer in light of this late afternoon stress test results? So that's not, the late afternoon stress test results was not news. Obviously it's better that they all passed with flying colors than they didn't, but I think the market kind of expected that. It's hard to say because I'm looking at, what it happened very, very fast is really, I guess, the point. So you had a 10% correction in the sector. I think you could still see, weakness could be lower prices, or it could correct in time or in price. You could get further weakness through August, September, October area, and then a year-end rally. You could just grind sideways and correct in time like big tech has for the last 12 months, and now it's breaking out. But I just don't see an enormous amount of upside over the next 3 months. But, we still hold the bulk of our core position. We've trimmed, but, we still have the core because we see over the next 2-3 years. Would I be buying a ton here? No. Maybe I'd buy Citi here if I had no financials exposure, but better things to do with the money. Better things to do with the money, and that's why we've been emphasizing Splunk and Baba and some of these utilities that have really come in a little bit, and some staples and some pharma. We still like Pfizer and Novartis. We think has some more juice, and the reason being that all of the in-person doctor visits are now, just flying. They've both got huge oncology portfolios. Many of those drugs need to be delivered in person, and more doctors' visits will yield more tests, which will yield more demand for the product, and that's that. So that's where we're focused. So do we love energy and banks looking 3 years out? You bet. In the next 3 months, do we love them? We like them. We still have a lot of exposure, but we've trimmed back to put money in some of these groups that we think can do better in the short term. So great question from Ben, and thank you guys for doing that. Anyone who has questions next week, just send them to info@hedgefundtips.com or go to hedgefundtips.com and hit the contact form. All right, couple key things we want to cover here. Nice underpinning to the market. Buybacks may prop up the stock market. That was rattled after the Fed meeting. So this chart from, I think this is the guy over at S&P. What is his name? All right. Yeah, Howard Silverblatt. Okay, legend. He's been around for decades. So this shows that buybacks are starting to come back materially, and dividends. So we think this is going to persist. It's nowhere near the 2018 levels yet, but so that's kind of the underlying bid in the market. And then Barron's buybacks and dividends are on the way as banks pass the Fed stress test. Silverblatt emphasizes that big tech is going to be doing a lot of buybacks, and then you also obviously add the banks. Here's one. Vertex approved a $1.5 billion buyback. They sold off on some drug news. There are a lot of those type of, like the BioMarins, et cetera, the Gileads that have just been in the penalty box for a year. They could start to move now in this environment. And then you've got, the mixed messages from the Fed. Kashkari opposed to rate hikes through at least 2023 versus Bullard saying 2022. Bostic, Fed should avoid prematurely declaring a win in the jobs battle. So he's on the Powell train. Williams says more progress needed before rate hike shift. So, it's basically evenly split, but Powell is the decider, and that's where it is. And my guess is if he keeps the pedal on the metal, he's got a better than coin flip odds of being reappointed in February if he wants the job. He also has cover to do so because commodities have rolled over ex energy. Lumber continues to skid below $900 with the commodity in free fall from May highs. And this is the Splunk news on Silver Lake, putting $1 billion into the convert that converts at $160 per share. So there's a lot of upside. And they'll be buying back stock to offset the dilution. So that was a nice catalyst. Netflix, we talked about on the Claim and Countdown 2 weeks ago. They just got upgraded, and they're flying slate of content, the international growth, etc. So they took the price target up to $586. Amazon, we talked about, I think, 2 or 3 weeks ago on the Claim and Countdown, and they just got upgraded after a 7% increase in Prime Day sales, having a new record and a $4,500 price target. So all of those things that we started talking about 3 to 4 weeks ago are now starting to come to pass in those groups, and that's that. And just going back to Macau. Sure, you have the screeners, but Peter Lynch has this great quote: investing without research is like playing stud poker and never looking at the cards. You have to do the work. And the only way you can have conviction, why would you buy Splunk at whatever, 112, it goes to 120. The guidance is slightly lighter than expected, but everything else looks good. The thing pukes down to 111. Everyone else is dumping, and you're buying. Why can you do that? When you know what you own, you can do that, and you can take advantage of others' emotional decisions when you understand the underlying business, and you can step in. And that only comes from research and experience, and you just have to go through the process. And that's why it's so important to love the game, because it's a ton of work. And but it doesn't feel like it when it feels like a treasure hunt every single day. Okay, now moving on to some Chinese development news. XPEV was one of the names we've been talking about for a number of weeks. It leaps after receiving green light from regulators to raise up to $2 billion. Jack Ma's Ant in talks to share data trove with state firms. This shows further cooperation, which I covered on the Bloomberg radio segment. And what this also means, as covered in Bloomberg, the changes at Ant, which included turning the company info into a financial holding company overseen by China's central bank, could also bring it a step closer to an initial public offering. That's the name of the game. And what we're seeing here are the Chinese stocks this week. It was a great week. Look what's happening with Baba. We've been pounding the table on this, and sure enough, it's finally going here from 210 to 228.50 this week, which is a nice move. Baidu's moving. They're all starting to move. And some, like Lee, which we talked about, and XPEV, they've already had huge moves. IQ is starting to tick up. Beely is breaking out. We didn't have any Beely. TME is even getting a bid, Tencent Music, Entertainment. So it's starting to happen, and I'm very excited to see this, and I think we're going to see some follow through in coming months. So so that's that. What is this? We covered that, and Eli Lilly. Oh, this is very interesting. I spent some time with the former CFO of one of the biggest industrial companies in the world when I was out in Omaha last week, and he made a point, and he knows this space like the back of his hand. We were talking about the Biogen Alzheimer's approval, and while the underlying science might be questionable, but it's moving the right direction. And he made a point that I had never considered, and it was the most brilliant thing I'd ever heard, is that if you get an Alzheimer's drug, the value of insurers that have been weighed down by their long-term care insurance exposure will explode in a positive way. So I thought about that, and then sure enough, this week, Eli Lilly surges after getting breakthrough therapy designation from FDA. Analyst raises price target and sees approval chance at 90%. Biogen plunges. If one of these drugs proves to be valuable for Alzheimer's, those insurers that have long-term care exposure, which is, and I didn't realize, the vast majority of the cost is related to Alzheimer's care. So if these people get cured from Alzheimer's or it gets prevented with one of these drugs, they're not going to need the a big portion are not going to need the long-term care facilities, and those insurers are going to make a ton of money because they'll continue to collect massive premiums and they won't have to deliver massive services. So obviously the biggest one that everyone knows is Genworth. So we just started nibbling. Look, this is something that's going to take years to progress. This is not a trade. This is a long-term investment. But if you believe in the Lilly or the Biogen or future ones coming, I didn't understand the implication on the long-term care books because so many of those companies went out of business, particularly in the great financial crisis. There are a number of publicly traded long-term care insurers that just went belly up and the states had to take over the book. There may be a huge opportunity for, even astute private investors or companies to start to buy these books, because if this catalyst comes to bear, that it's just going to be tremendous for the long-term care. So you just never know. You talk with smart people and you hear ideas like this, and it made a lot of sense. So don't have a crystal clear actionable plan, but it's something to keep an eye on as more of these Alzheimer's drugs get approved and start to make a difference, and that's very positive for a lot of families. Okay, so this is just an indicator we put out today by happenstance, and it just kind of shows that while the Nasdaq's had a huge move in the last 3 weeks, here's one indicator that says odds favor. There's probably more gas in the tank in coming weeks. And this was the article of the week. The Sam Hunt breaking up was easy in the 90s stock market and sentiment results. The point here is that there's been a lot of pessimism, particularly last Friday, those trying to break up with the market. It was much easier in the 90s when there wasn't $120 billion a month in bond purchases and unlimited liquidity to save the day. The market continues to climb the wall of worry. We saw fear and greed gauges, NASDAQ breaking out to new highs, and the fear and greed is at fear level 35. It's on a scale of 0 is max fear to 100 is max euphoria. 35 is fear, and that was on the day that the NASDAQ was breaking out to new highs. So the market continues to climb the wall of worry, supported by ample and unprecedented liquidity. And we covered some of the key points of Powell's testimony and the implications. This is interesting. On Friday, I was on standby to join the claim and countdown if the market continued tanking at the end of the day. It kind of held up at the last hour, so I didn't go on. But one of the things I was going to cover was that obviously you had the Bullard comments and you had quadruple witching Friday, but the NASDAQ advancing, the NYSE advancing volume minus declining volume was at a low only seen several other times in the past 2 years. And you can see they were coincident with short-term lows, pretty much coincident with short-term lows, coincident with short-term lows. So that was the point I was going to make on Friday afternoon. This level really got accelerated, and sure enough, we saw the bounce this week, and that was that. So we've covered a lot about Powell. This was the chart that Ishika covered and Moxie covered in the Bloomberg article they included me in. I thought this was really valuable. It shows the relative undervaluation of Chinese stocks to U.S. Asia stocks valuation gap to U.S. peers remains below historic average. So there's usually a negative 3 turns, 3 multiple spread. U.S. trades at a premium to the Chinese and Asia stocks. It's now gotten down to -6. And this is what I like to do. I'm a mean reversion guy. I'm a sector rotation guy. When these things get out of whack, I look at the fundamentals. I say, are they going to stay out of whack forever? Or is this just an emotional short-term extreme? Short-term market's a voting machine based on emotions. Long-term, it's a weighing machine based on fundamentals. And I look at Alibaba's fundamentals, and I look at some of the other holdings that we have, and I say, I want exposure, and that's what we've been doing for the last month. And forget overshooting to the upside like you did in 2011 after the great financial crisis. If you just reverted to the mean, 2, 3 multiple turns to the upside, it has enormous implications for the leaders in the group, and that's what we're counting on. So retail is still a little bit exuberant, 40% bullish. Fear and greed, this is what I was showing, new highs on the NASDAQ. People are still scared, climbing the wall of worry. And the National Association of Active Investment Managers. This is interesting because let me just get the update, because that prints on Thursday and the article I write on Wednesday nights, but let's just see what it got to. I think they just puked out on Friday, which was good to see, because now they got to chase up again. So yeah, they puked down to 70 from 98. So this dropped to here, which is 70, and that was largely a function of Friday. They all got scared up by quad witching. So if the NASDAQ pushes higher, they'll have to regain that exposure again. The message of the week, selective tech, Baba, Splunk, Netflix, Amazon, and defensive, selective utility, staples, and pharma is where we believe opportunity is right now for summer, as cyclicals will likely shake out some of the late money in coming months before resuming their uptrend new highs later in the year. We're still in the early stages of a new business cycle. We've modestly trimmed taken profits on some of our cyclicals from last year in recent weeks, kept core positions, and will potentially add back to them in coming months on weakness. When you're ready to throw in the towel on the next pullback, remember Sam Hunt's soothing words, breaking up was easy in the 90s at the end of a business cycle. It's much harder to bail just 1 year into a new business cycle coupled with unparalleled money supply growth. So that was that. Let's take a look at some of the unusual activity this week. A lot in Alibaba, believe it or not. So here was 1,400 contracts. Las Vegas Sands, we like 15,000 contracts for September 55 call. Another BABA today. This is nuts. It's June 2022, 1,700 contracts at a $410 strike, which means basically a double from its recent low inside of a year. From their lips to God's ears, man. I'll have a party at our place in Connecticut for all these well, let me not make it. Anyway, that would be amazing. Let's just put it that way. All right. So consumer staples earnings I covered. The 2021 earnings powers went up 1% for this group in the last 60 days. For 2022 went up 1%. But as we know, while earnings are up in this group in the last 60 days, the prices have been moderating to down, and that we see as an opportunity, and we've covered those in recent weeks. As for the economic data for the week, and by the way, if you're on the podcast, you're going to get cut off in a couple minutes. Just go to hedgefundtips.com, click on the videocast, fast forward to minute 60, and you'll be able to get the last few minutes. Let's just cover some of the highlights. Existing home sales were good, beat expectations, 5.8 versus 5.7. Huge draw in oil. Obviously, demand's coming back. You see the traffic on the roads everywhere. Air travel's coming back. That's only going to get bigger as people love saving money and going on Zoom, and businesses love that until they lose business to competitors who took their prospective clients out to a steak dinner. I can assure you that they'll all be back on planes buying steak dinners before you know it. And what else? Continuing claims, again, actually, continuing claims was positive. That came down better than expectations. Initial jobless claims missed expectations, so we'll keep an eye on that. And then durable goods orders were a little light. And core CPI price index came down a little bit, so that was good from an inflation standpoint today. Personal income fell 2%. And then consumer expectations were down a little bit. Consumer sentiment, 85.5 versus 86.4. Keep an eye on that. And that's the story on that front. The rig count was actually down one rig. So that's interesting with prices up. And then finally, earnings estimates. This is forward 12 month, so it's not 2021 and it's not 2022. It's basically mid-year this year to mid-year next year. It looks like it's up to about 205, and it took a jump here. So this has exceeded expectations. We've always been talking about 190 for 2021 and 210. They're already exceeding that. So while prices got up a lot, so have earnings. And I think the name of the game here is to continue to focus on the rallies under the surface, pay attention to what's lagged. I think that's the opportunity in the next few months. And then we'll get back to the other stuff we love towards the end of the year if we get some weakness to add back. So with that said, I'd like to thank everyone for listening in this week. We'll be back next week. Thanks for listening in. In the meantime, make it a great one.